Hi, welcome to this video series where I answer questions related to finance from the readers of Monevator.com. Monevator is the leading UK blog for personal finance related issues. The question in this video comes from Rick, who asks how often he should consider maintaining his investment portfolio and whether the frequency with which he should check out new products in the ETF index space. Now, first of all, there's no firm rule for this whatsoever. And just take a little bit of a step back. One of the major benefits, on top of probably making you wealthier in the long run, of a passive portfolio is that you spend very little time on it. You don't have to spend a ton of time reading the Financial Times, Wall Street Journal, research reports, understanding whether Facebook is a better investment than Apple. No, you buy the broadest, cheapest index tracker and let the market do that for you. That saves you a ton of time. But also keep in mind that if you, let's say, invest in a market that's up 10% and you're up 10%, you could make that same investment with zero time spent and almost no cost. So let's say now you're up 12%, so you're actually beating the market. It's only the 2% that you spend all that time to achieve, because the 10% you got via the market. Now, in reality, I think we're all guilty of remembering returns as better than they actually were. So I'd even question whether you can reliably make 2%. But even if you did, it's only 2% you spend all the time on. So coming back to the question, I would say definitely have a look at your portfolio when there's money flowing in and out of your investment portfolio. I would say have a look at where the portfolio, when something in your personal circumstances has changed that could impact your risk profile. This could be both a personal thing, such as, start with a positive bonus at work, but it could also be you lost your job, etc., a windfall like inheritance, which is often obviously not a good thing. But it could also be external, such as an economic crisis where you live. But I would definitely have a look in those circumstances, and perhaps it's not a bad idea to get help from a local financial advisor. But in general, I'd say if you look at this every 3 to 4 months, just to make sure things are not totally out of whack, and then have a more thorough review once a year, perhaps again with a financial advisor, that's not a bad thing. And in general, when you hear of lots of financial drama in the news that could impact both the markets and currencies, again, check out how that impacts your portfolio. Of course, also, as Rick suggests, once in a while, you should think about, are there better products out there? Has your tax situation changed? Again, that could be worth talking to an advisor about, but even just having a look and think about it is not a bad idea periodically. So I hope that answers the question. My name is Lars Kroijer. I'm a former hedge fund manager who's written a couple of books about finance, and I'm now doing these videos as a hobby. The premise of a lot of my work revolves around how the vast majority of investors, in my view, have almost no chance of outperforming the financial markets. I explain what this means and why it's likely a hugely positive thing for most investors to come to understand and embrace this premise. There's more about this in my books and other videos if you're interested. But thanks a lot for watching. As I said, there are other videos in this Q&A series, but in any case, I hope you found this one interesting.